My name is Michael Guyette, publisher of the Lead Lag Report, the Wolf of all streets, Mr. Scott Melker. Scott, I know a lot of people know who you are, but introduce yourself. Who are you? How'd you get involved? Interested in the cryptocurrency space? And what are you doing now?
Thanks for having me, man. How did I get involved? I guess I'm a glutton for punishment. I've been in crypto since 2016. I came in largely as a trader, so I had dollars in mind. I was literally just there at the perfect time for all of those mythical 100x unicorn altcoin pumps that we've all heard so much about. So very lucky timing when I came in. Of course, then the market eventually took a turn for the worse. And at that point, me, like many others, admittedly, took a very, very deep dive into the actual asset class and the importance of it. And fair to say that at that point I was orange pilled. I would say that my conviction only increased through the last. I won't call it a financial crisis because everything actually went up after the COVID crash. But the nonsense of monetary policy and printing and manipulation that we've obviously seen from the Fed throughout that time just strengthened my case. And so in that time, I have my Twitter account, of course, a free newsletter that I write 5 days a week, a podcast that comes out 3 days a week, live streams 5 days a week. I've got a lot going on. So I basically spend my life 24/7 when I can talking about, writing about, thinking about the crypto space.
I want to focus on the term FUD for a minute here. I just retweeted, I shared it in the top of the space. Feels like we should do a Twitter space that's just discuss the amount of FUD that's sitting all at once. Now,
It's insane.
Well, so first of all, let's go a little existential for a second. How do we determine what's actually FUD and what's not? Because you can look back, I think, with hindsight and say a lot of things that people would shoot back and say that's FUD ended up having some merit to it.
Sure. FUD obviously stands for fear, uncertainty, and doubt. I don't know if you lost me there for a second. Fear, uncertainty, and doubt. FUD. FUD. The short answer is nobody really knows. But I can say that in my experience in crypto, when we see these massive waves of fear, uncertainty, and doubt at the same time, it starts to look like bear market piling on from the media, from governments, from regulators. We've seen a very, very clear uptick for one reason or another in regulatory enforcement action against players in the crypto space, certainly in the United States. Over the past month, a endless wave of Wells notices, lawsuits, etc. So there's a clear mandate, whether that's a result of all the contagion last year, which is possible and potentially justified, or just this is the perfect timing because of that for them to sort of pile on the industry and take control. That's up to individuals to determine. But I will say that right now it is hitting from so many different angles on so many different levels that it bordering on absurd. And a lot of it, whether you believe it or not, when you dig in, it could end up being true. And we've seen a lot of things end up being true. But the way a lot of these are presented, I'll give the $1.8 billion coin movement from Binance to hedge funds that was widely reported and started by Forbes. When you actually dig into that story, it's based on sort of loosely interpreted on-chain data, easily explained, whether justifiable or not, by Binance. And it seems like when you read the clickbait headlines and the way that things are presented, that they're making a case rather than presenting facts.
Do you think that's just because of the natural tendency for journalists to try to have some clickbait, get some attention because now everyone's piling on it, or is it some other top-down directive, you can argue, as far as the narrative?
Both. So I think it's more of the former and less of the latter. I generally, although people have made good cases, I generally try to avoid putting on my tin hat and going too deep down the international cabal conspiracy against cryptocurrency, central bank digital currency narrative, although it has some merit. But just looking at it realistically, let's talk about Binance, I guess, as an example, right? Of course. So I just mentioned the one piece of news. The other glaring piece of news with Binance at the moment is the SEC's enforcement action against Paxos, who mints BUSD, which is Binance's stablecoin. Paxos, that's not their only stablecoin that they mint, and Binance does not mint that coin. Paxos has their own called USDP. Strangely, the SEC did not pursue any sort of enforcement action, didn't even mention the other stablecoins that are literally structured, minted, backed in the exact same manner as Binance. I haven't heard the SEC necessarily talking about USDC, which I would argue is the favored and anointed winner in the stablecoin space by legislators and regulators. So this seems like yet another sort of surreptitious side attack on Binance, a way to take them down a peg because they're a quote unquote offshore exchange. I always find the term offshore exchange funny because it's such a United States centric sort of a derogatory term, as if we're the only place on earth when crypto is global. But it's very clear that there is some sort of attack happening on Binance one way or another, which is so easily explained by the fact that only one of the two stable coins and others that Paxos is involved in was actually targeted.
Now, obviously, I don't know the space anywhere near as well as you do, but is it fair to say that Binance is sort of the elephant everyone's targeting now?
I think I would say that there are a few elephants. Binance, clearly Tether. If you saw today, there was a Wall Street Journal report that just dropped about 3 hours ago, accusing Tether, which is USDT, for those of you who don't know, of trying to evade banking regulation, forging documents, using shell companies to get banking relationships. And this is years ago. To be able to be banked and to be able to back the asset, because of course, if you're going to be a centralized stablecoin, you in theory need to be fully backed one for one by dollars and government treasuries, basically liquid dollar equivalents. Now, in the case of both Binance and Tether, one could make the argument that they started as shadier enterprises, and just by sheer size and time in existence, they've found a way to become legit. Interestingly, CZ from Binance made a really interesting argument a few months ago when talking about the pursuit of regulation, which, by the way, if you're a crypto exchange, you have to deal with every single regulator in every country. And when you enter the United States, you have to deal with every single state within the United States. So getting regulated is a near impossibility, especially when there's not much clarity on how to do it. But he made a really interesting corollary to the invention of the automobile, right? He said when the automobile was first invented, they were slow. Not many people had them. There were obviously no laws. A couple people driving down back roads, dodging horses and buggies. Well, as they got more popular and became faster, well, that's when you started to see regulation around cars, right? Speed limits, stop signs, rules of the road, seatbelts, safety precautions, because the regulation had to catch up with the popularity of the car. And he likened Binance to that. When they started in, the mid 2010s, there was no kind of regulation. But does that mean that a crypto exchange should not exist or attempt to operate because the regulation doesn't exist? No. His argument is that they've attempted to become compliant jurisdiction by jurisdiction as the regulation has become cleared. I think that, whether you believe it or not, is a major challenge, obviously, for someone of their size. So I do believe that at this point, Binance is trying very hard to become a regulated entity. I was on a Spaces actually earlier with CZ today, and he effectively said, listen, my job now, he's like, I don't run an exchange anymore. I don't get to talk about these assets. He's like, my job is to talk to regulators, and I've seen him in person. His other job is to take selfies and smile, right, and be a politician and a PR agent. So Tether may be very similar. There was a lot of stories about Tether in the earlier days, and not even until the last 18 months, 24 months, about how Tether was backed. A lot of stories about difficult audits and inability to get a big four firm to audit them. But at this point, I mean, it was Cumberland or somebody, but they just recently released basically a report that said Tether was fully backed by short-term treasuries and dollars in federally regulated banks, et cetera. And so now, of course, we start to see the FUD stories from the Wall Street Journal saying that Tether did these things in the past. Even if they did, my assumption is that you'll see some sort of slap on the wrist or fine, which has been the par for the course, and we'll move on. But there are some very large players that the United States government is very unhappy with. It's my opinion from looking at all of this that, as I sort of hinted at before, USDC from Circle, which obviously has a relationship with Coinbase and a close relationship with regulators, might be the pre-anointed winner in the stablecoin space, could even eventually, frankly, become the de facto central bank digital currency for the United States. but that anyone who's a competitor to Circle probably is going to see some attacks from regulators.
Why would, and this is just again part of my own naivete here, but why wouldn't traders, investors hold off and let the dust settle? If there's a lot of interest in the cryptocurrency space still, and people are attracted to these prices, why not just wait a few months and see how it shakes out? Why is there sort of still a desire to kind of hop in despite the turbulence?
Well, the dust might not settle, or the dust might not settle for years, right? I think that in our echo chamber with our level of self-importance, we assume that we are top of the docket for legislators and regulators. But I would almost take the flip side, which is that we continue to see Gary Gensler in the SEC using the few tools that they have, since he's very openly stated he believes he has the mandate and all the tools he needs to regulate this industry and that we don't need anything further. Sort of goes back to the old adage, if the only tool you have is a hammer, everything you see looks like a nail. And so I think that he believes that he has the mandate to fully regulate this industry, and he's going to do that through enforcement. And, just last summer, so now it's been 7 or 8 months, we saw the Lummis-Gillibrand bill put forward. There was all kinds of hype and excitement around that. You haven't heard a word about it since, right? For anyone who's not familiar, it had some pragmatic and pretty actually realistic and rational ways for legislation on stablecoins and crypto as a whole, and some tax relief for people who do small transactions with crypto, so that they're not selling their Bitcoin every time they want to buy a cup of coffee. Really just intelligent, well considered, and that's coming from someone who's not a huge fan of our government. Bipartisan, of course, Lummis being a Republican from Wyoming and Gillibrand being a Democrat from New York, right? And you haven't heard anything about it. So it kind of goes back to what I just said about CZ and Binance. You can wait for the dust to settle, but the dust may not ever settle if they continue to fight, right? And if you've been in this asset class for a long time, this isn't unfamiliar. It's just an uptick in the same rhetoric. I've had Mark Yusko on the show quite a few times, and he loves to give the, first they laugh at you, then they fight you, then you win. That, that old adage as well. Well, we're definitely in the then they fight you phase, right? And they're fighting extremely hard. And even more importantly, I think, once again, the question you asked is, I think, a very US-centric question. There are plenty of places on planet Earth that are not the United States where people can very comfortably invest in these assets. The bulk of investment in the cryptocurrency space is not in the United States and is in places where people are far less concerned. So basically what you end up with is the United States lagging behind in the new technological advancement, which is something the United States historically has always led on, not lagged on, to use your own title, I guess.
Do you get a sense that a lot of the leverage has come out, or is there still sort of a good amount of margin across the space?
I think there's always a good amount of margin across the space, but I would say that the bulk of it was rinsed through all of the contagion of last year. That said, humans are going to human, right? So we're going to see that completely repeated. The leverage will build once again, but even today, right? So last night we had a $1,200-ish, $1,300 drop in Bitcoin in less than 30 minutes. So a 5% move across the asset class, since obviously altcoins trade with sort of higher beta, maybe 7, 8, 9, even 10% moves on altcoins in that same 30 minutes. That was $60 million in leverage longs liquidated for basically that move. That was the biggest since August. If you go back before that, we used to see literally days and moves like that where you'd see 6, 7, 800 million liquidated. 60 million in this space is absolutely nothing. And we're talking about that like it was a huge liquidation event. So I think certainly from retail, the leverage is largely gone. And I think the institutions that were heavily leveraged have been rinsed, right? I mean, Three Arrows Capital was arguably one of the biggest. They were absolutely destroyed using leverage. FTX was a Ponzi scheme, leveraged to the hilt. Anyone who was a fund and was leveraged and had their coins on FTX, they got destroyed. Anyone who was long the entire time and suffered the contagion, they got rinsed. So I do think that most of it is gone for now, but I do believe it's all coming back one way or another.
Talk us through Silvergate, which I'm seeing in the periphery, and obviously it's been a big story. But first of all, just for the audience and for those who are not familiar, what is Silvergate and what's going on in the last several days here?
Well, Silvergate is is an actual bank, and they were one of the first, if not the first, in the United States to service the crypto industry, right? And there's been sort of a lot of stories now, even in 2023, talking about Operation Choke Point 2.0, that cutting the banking system off from the crypto industry would be the best way to kneecap the industry, which is obviously true. It's great that you can trade crypto, but if you can't get your money out into a bank, if you can't convert your Bitcoin into fiat, that's basically the easiest way to end the industry. Well, Silvergate was the first bank effectively to bank, Coinbase, Paxos, Circle, all of these companies, Gemini that we talk about, and every single one of them abandoned Silvergate within the last 48 hours, which to me is, I mean, I get it, it's a business decision, but extremely, extremely sad. But they themselves, had massive loans out to a lot of players in the industry. They were FTX's main bank, and so basically, there's just a huge sort of, once again, seemingly a bank run on Silvergate Bank, something that we saw in crypto, but not in an actual financial institution, if that's what you want to call them. And people running for the hills and abandoning it. And also, they failed to really be able to report on their accounting and need some more help. They have the Department of Justice looking into them. They have regulators looking into them. It's basically an epic shit show. And everybody's abandoning them. So this is one of the few banks that really has confidently and excitedly banked the crypto industry for all of these years. So it's a relatively big deal.
Yeah, and I got to imagine that's going to make a lot of other banks not want to go down that road, given kind of this example of being made of Silvergate.
Yeah, I think so. Although it seems that everybody just pivoted to Signature, which is sort of a very similar business model. And there's some people who are not quite, I don't have much knowledge of it, but who spoke pretty aggressively against Silvergate's business practices and leadership. So there were a lot of people who maybe saw red flags or just didn't like the approach that Silvergate took. But yes, I mean, I think that 2022 in general, and Silvergate is yet just another victim, I think, of all of that contagion or player in it, is going to give major pause to a lot of the bigger banks. But that said, on one side, right, as much as we hear the Jamie Dimons of the world talk about how, Bitcoin is a Ponzi scheme and going to zero, every single day we hear more news from Goldman, JP Morgan, Morgan Stanley, certainly from the Fidelity, who's been deeply entrenched in crypto for a long time, all actually adopting the technology, moving to allow their wealthier clients access to the asset class, the ability to trade and invest. So it's sort of a watch what they say, not what they do situation. I mean, you may recall that only a few years ago, it's this regime change, I guess, really under Biden, although I don't really give him credit or blame for it necessarily, to Gary Gensler and to other leadership at regulators, stopped a lot of actually really positive momentum that we had. When Jay Clayton was at the SEC, I think he took a very reasoned approach to crypto. Brian Brooks, I believe, when he was the head of the OCC, wrote a number of letters. I mean, they allowed banks to explore stablecoins as an alternative to SWIFT and ACH, which is something actually in Japan today. There was an announcement that three of the major banks in Japan have gotten together and are testing stablecoins for payments, just in the same way that we discussed that here. I mean, SWIFT is like it's just under 100-year-old system, right? 70-year-old system or something. Anyone who sent a wire knows that sending a stable coin in 30 seconds is a lot better and arguably a lot cheaper. So these things are still moving forward and happening. Clayton also said that the State Streets of the world and the BNY Mellons, who are actively looking at this, could custody crypto assets for people. So I don't think that this is going to be that big of a deal for other banks. But listen, if you're on the fringe or you're on the margin and you were considering it as a smaller bank, you might not do it anymore, at least for now. That's where we might need to wait to see the dust settle for a lot of people.
Yeah, I have to. All this sounds actually, I can argue, positive in the sense that this is how you get a forced decoupling against equities. Right now, granted, it's the wrong way, right, for now, right? But if you take the institutionalism out of the cryptocurrency space, then conceivably you take some of the co-movement out to other risk assets.
Yeah. I mean, we got what we wished for to some degree, right? Everybody talked about institutional adoption, wanting Wall Street here. There's a long history of those being negative top events for the crypto space, right? CBOE or CME futures. Now I'm blanking on which one was approved and started trading on December 18th, 2017. Not coincidentally, the dead of the deadest tops of the 2017 bull run for Bitcoin when it hit $20,000 to the day. The Bitcoin futures ETF approval, also the dead top of that entire market cycle. These are products that were offered to institutions who hated the asset class and could short it, right? So yes, I think to some degree we got what we wished for, and if institutions are less interested, then perhaps your argument holds water. But I think, honestly, a lot of institutions have been entering the space quietly. I mean, I gave you a list of all the JP Morgan, Goldman's, all those, obviously, Fidelity increasing their activity. I just think that this is a quiet period, but I think that's true across all markets. Now, for the decoupling, that's happened, right? Historically, obviously, Bitcoin has been largely an uncorrelated asset from other markets. I mean, if you look at it on a 10-year period, correlation is like 0.15. It's extremely low, obviously, almost no correlation. I think it's zero effectively to bonds. And even zooming in, which is not the way to look at correlation, but over a 40-day period, the highest it ever was May of 2021 at 0.8. And it's now hit a low since then of 0.3. So becoming largely uncorrelated. And you can see that even anecdotally staring at the market. If you look at the chart, in June, everything sort of bottomed. Bitcoin was just boring for the entire summer while sort of stocks and bonds bounced all over the place. And then, as you pointed out, we saw a major black swan event in the crypto space, which was FTX, and a clear decoupling to the downside, right? Of course, we had a major crash. Nothing was really happening in the stock market. And since then, it only took 2 months for that entire crash to be retraced, which to me was a really sort of bullish and interesting signal from the crypto space that, by January, price had rocketed right back up to where it was before the entire FTX collapse, which at the time seemed like the end of the world and the end of crypto to a lot of people. And now we've been chopping around still above those levels for all this time with that majorly decreased correlation. I mean, today is one of the most interesting days you can look at if you're a short-term correlation maxi, right? I mean, we have Bitcoin down 5-ish%, stocks up pretty big, and GBTC, which is supposed to effectively track BTC, is up. It's an equity. So the markets are all over the place and clearly not much correlation.
What about within the space? So, it seems like whenever I look at the cryptocurrency tab on the investing.com app, and people make fun of me using that, but whatever, it's just the easiest one on my phone here. It seems like they all either go green or they all go red. What's needed to break the sort of intercorrelation within the space?
That's a really interesting question, and it's sort of the holy grail question, because we all know that in any sort of liquidation event or negative news cycle, all correlations in all markets basically go to one, right? Everything becomes correlated. Well, that's extremely and more readily clear in the crypto space if you consider it its own ecosphere and the assets being, individual things that you can invest in. So when you see Bitcoin drop, like I said, if it goes down 5%, usually you get a 10% drop in altcoins or even worse, right? And the lower cap, the more they move relative to Bitcoin. Now, sometimes on the way up, altcoins, at least versus Bitcoin, stay relatively flat. In a bull market, the way that people generally trade this market, and that's because there was not that much new capital coming in, is when Bitcoin is in a generally safe spot, moving up but trading sideways. That's when you see the decorrelation and altcoins kind of go absolutely nuts. And that can happen within certain sectors, right? We saw DeFi summer, NFT summer, metaverse fall. We just saw this sort of mini bubble in AI related coins. But to me, those are all kind of stupid narratives. The reality is that Bitcoin remains king. I think that Ethereum, to me, is the more interesting asset actually for trading, and certainly for swing trading or for the next few years of investment. And I'm not saying that as I think Bitcoin is a more important asset if shit really blows up, so to speak, right? I mean, people hold Bitcoin just in case we go full Mad Max, which I don't necessarily think is going to happen, but it's nice to have some of your money in something that could behave as a hedge against that happening. But Ethereum, I think, for me, has much bigger swings. It's sort of a trader's dream and a lot more upside moving into the future. So I do think that there are a lot of moments when the market is either in a bull run or safe where they decorrelate massively. But when you're in a bear market, you kind of get that same familiar pattern of more pain in altcoins on the way down.
Let's talk about the trading side for a bit here. How do you trade through this? There's always this line that traders love volatility. I always kind of have an issue with that because you can get whipsawed like hell, right, with volatility. But what are some of the indicators or things that you use to help you determine entry and exit points?
To be totally frank, I sort of agree with you and have stepped back and have not been trading particularly aggressively. I filled all my sort of longer swing bids on the way down, and now I'm just waiting. Right? I mean, I bought Bitcoin 21 down to 16, and those were standing bids for months. And Ethereum, 1250-ish, caught a little bit below that, and obviously that's to add to massive positions that I've never really touched. But it's a very, very, very difficult market to trade right now. I think all markets are relatively difficult to trade, to be quite honest, at this point. But for me, when I'm looking for those swing positions, listen. I've in my years of trading and basing it on technical analysis, which I'm the first to admit, jokingly, is sort of astrology for men, right? I don't think it's a science necessarily, and for women. I don't want to be sexist, but you can look at a chart and determine a strategy, and even if it's unicorn dust and tea leaves, it gives you an actionable way to decide where your idea is invalidated and how large your position size should be, right? So you determine where you want your entry to be, and whatever strategy you utilize, support and resistance, Ichimoku crowd, RSI, whatever you use, that helps you determine your stop loss, at which point you then determine how much of your portfolio you're willing to lose if you hit that stop loss. And then you should go about your day and ignore the chart until you either stop out or hit whatever area you were looking to take profit. For me, after trying basically everything over time, I think you come to understand that less is more, really price action and volume rule. For me, I do utilize RSI, but only to give me signals of when you might get a good bounce in either direction, right? If you're massively overbought or massively oversold and you see some sort of divergence with price, bullish or bearish divergence, that's when I'm more inclined to take a sizable position. And at this point, I just feel like bigger positions on less assets with a longer sort of time horizon is the way that I'm much more comfortable with. I've tried the daily scalping with leverage thing, and I don't have the calm and mentality to do that long term, and I don't really think that 99% of people should.
Did you get a sense that the low might be in, or do you think we're still going to break?
I think the low is absolutely in, unless the unknown unknowns strike. Because I would have told you in June that the low was absolutely in, and I think it was, if not for FTX, right? So I can only assign probabilities or the idea, but listen, we're sitting at 22 to 23,000 ish. Pretty big drop to get below 16,000. I don't know who has that much Bitcoin left to sell. Right. I mean, even when you looked at FTX, people thought it was going to be this major event for Bitcoin. It was going to drop so massively. Well, it dropped less than sort of other black swan events before. And if you took a look at the balance sheet of FTX, there was no Bitcoin left. Right. I mean, Bitcoin is the asset that trades 24/7. It's liquid, 24/7, 365. When people needed to sell shit during all of this, not just crypto collapse, but during all of this bear market and stocks and everything, when you're panicked and need money on a Saturday, you can't dump your Tesla, right? But you can sell your Bitcoin. And I think that we've had almost everyone who intended to sell or had something to sell and needed liquidity, they've basically sold their Bitcoin. For me, I can't find mentally, unless there's Mount Gox creditors, so maybe, a couple 100,000 Bitcoin come online. I think that's dubious at best. Listen, I don't think there's any chance of this almost, but if for some reason Grayscale collapsed and they had to sell off the entire, Grayscale Bitcoin trust and liquidate that, that's 4 or 5% or 6% at this point of Bitcoin supply. It would take something like that for there to be enough Bitcoin to put in a new low, unless all markets are just, unless we're entering the Great Reset and a huge, massive Great Depression and we see a major grind down for months and years. I would be pretty surprised if the bottom wasn't in.
Yeah, unless you have like a credit event, right, in which case everything will correlate. I would assume you probably
Right.
Bitcoin space. All right, so let's talk about other investments that you yourself look at. So, presumably you're doing more than just cryptocurrencies and Bitcoin. Are you trading around stocks? You're looking at bonds and saying to yourself, "This is kind of interesting here," or what are you doing?
I bought a shit ton of bonds, man.
Yeah, let's talk about it.
It's hard for me to say because I've been one of those rail against bonds
Well,
people
hold on. First,
for quite a
what
long
kind of bonds are
time.
we talking? Treasuries? Are we talking AAA, junk?
Treasury 2 year, 4 to 5% short term treasuries. Nothing crazy. I mean, listen, yes, I know that I'm not beating inflation, but there's a certain time I think in the market where you have to admit that you don't necessarily know what's going to happen. I mean, it's kind of the hedge fund mentality for a retail investor, right? I'm going to lose less while things are bad. And I think it's really hard to argue with 4 to 5% yield in this environment when it's very hard to know what's likely to come next, in my opinion. I mean, I'm assuming you agree.
Well, yeah, I put out that tweet. Yes, I don't even know what day it is anymore. Just given the stomach bug I've got, but it's like you always get the questions like, why would anybody even bother with the stock market when you get a guaranteed 4.95% yield? And my response is, people are degenerate gamblers. Right? They love that zero DTE fast money. So I'm in agreement with you. Listen, I keep going back to it's beyond my understanding how people still don't understand there are lags between interest rate movement and when it affects the economy. So everyone keeps talking about, why bother putting 5%, getting a 5% rate of return in 2 year treasuries? Well, because it could very well be that the Fed already over tightened and inflation could come down quite a bit next year. That's not a very popular thought, but
That's my exact
yeah,
thought.
well, that's my point, and it's not a popular thought because people are confusing rates today with inflation tomorrow. Right.
The Fed effectively has a 100% hit rate on overcompensating in both directions, right? I love when people defend Jerome Powell, and Powell now say he's done a great job. He's brought inflation down from 9 to 6%. Well, why the fuck was inflation 9% in the first place, right? So it's like, yes, if you can create a disaster and then be the one to fix it, I guess that could make you be a hero to some degree. But I just don't see it that way. But the Fed is always wrong, and they're always wrong aggressively, historically. So they obviously overshot on the upside. If they really wanted to tame inflation in the first place, to your point, because there's such a major lag, they should have reined in QE 6 months to a year earlier, if not more, right? And so I think we all know, I would argue that they've already overshot because inflation has come down massively. I don't think inflation is necessarily over. I think that inflation will be one of those things that we just slowly see higher lows in inflation. 2% becomes it's okay to be 2.5%, becomes it's okay to be 3%, because the reality is that easy money, while it may be over for a while, that's the only way that this Ponzi scheme works moving forward, right? And forever. So, yes, I think that locking in 5% right now, if inflation could be well below 5% in the coming year or two, is a really good move. And if you think stocks are going to go down, locking in 5% and losing less is the appropriate mentality at this moment. You can't always be hitting a home run every single year, right? I mean, if you zoom out and accept that, hey, I'll lose 1 or 2% versus inflation, my cash buying power this year, but I'm going to actually grow the size of my portfolio by simply sitting in bonds and doing nothing.
I think I lost you in the last bit there, but I will say real quick. I think it is just, I don't know. I can't understand the way people think when it comes to taking a guaranteed rate of return versus a chance on a potential loss. Right? They'll still want to take the gamble on stocks, but yeah, that's the nature of the beast. Now, the thing is, like even today, this has been a pretty strong week, right? I mean, I think a lot of people were surprised by the way stocks acted this week, including treasuries. The long end of the curve actually agrees that you're probably going to have a recession or disinflation. Long duration treasuries haven't broken, in a meaningful way their price, even though the 2 year yield keeps pushing higher. So it is intriguing to me now. The thing that kind of makes me nervous is I keep going back to there's a lot of debt that's going to be rolled over next year, presumably into higher rates. That's where the credit event risk is. It's not there just yet. That's why I said which bonds, right? I suspect that junk debt is going to have a real hard time at some point this year, but again, not yet. What are some of the things you'd be looking at for wanting to take on more risk into equities beyond just the idea that they go down? Would there be a set of conditions that you'd look at to say, okay, well, you know what, maybe I shouldn't have done that bond trade. Maybe the time actually to go into stocks is here.
I mean, I don't think that I will regret the bond trade, right? I still have a stock portfolio and will benefit from any upside that comes with that. So I don't necessarily see that as a major risk. But can you hear me, by the way? Because I'm
Yeah, you're good. Yeah.
weird connection. Yeah, okay, good. Listen, so it's interesting because I have to believe that Bitcoin is going to correlate for me to say that the bottom is in for Bitcoin and maybe potentially would not be in for stocks. So take that as an understanding. I do think that that's possible. But if you look historically at certainly the last few collapses when we've had the yield curve inversion sort of precedes the recession, right? So you get the yield curve inversion, which is way more inverted than it has been in those past situations, even in the Great Recession and such. Then you get the mythical Fed pivot that everyone seems to be so excited for, right? The Fed stops tightening, obviously, and pivots maybe even to more QE or lowering rates. I don't think that's going to happen. I think they just pause. But a pause can be a pivot, I guess, in this context. Every single time it goes yield curve inversion, Fed pivot, then market bottom, right? So maybe this time is different. They're very dangerous words because we've already seen such a sizable drop. But you know, we're talking about a classic sort of real bear market into a recession. You might see, instead of this sort of 15-20% drop in equities, you might see a 40% drop in equities, right? That wouldn't be crazy. So either we revisit those lows or it goes lower, but you have a lot of historical precedents to say yield curve inverts, then the Fed pivots, and that's not when markets go back up, right? Then the bottom comes in months later, and then things start to rise. So I think right now, extreme patience and just sitting and taking what you can get is probably the right move, at least for me.
I saw you like that like that tweet I put out about they're going to invert the ever living shit out of the yield curve even.
Yeah, that thing's not going. Yeah, we're turning Japanese, right? Yeah, I mean, whatever.
Yeah, but let's talk about that a little bit because there's the automatic assumption that that means we're going to hit a recession. I keep going back to yes, most recessions tend to be preceded by inverted yield curves, but not every single inverted yield curve means a recession. It's like I don't know how much more damage you need to have to destroy housing from what we've seen. I mean, so what? Okay, mortgage rates are 7%. What, you just go to 10% to stop all housing construction activity? I mean, you can't be that far.
Yeah, but I mean, in the 1980s, my parents bought a house with I think a 14% interest rate, right? So it's like that's sort of the thing is like you get these lower highs because they can only press so far. But 6 and 7% interest rates historically are somewhat more average than high, right? It's not so strange. It's just when you've been in effectively a negative interest rate environment for so long, it seems absolutely insane. But I agree. I don't think it's going to go that much higher. And I think what's even more sort of anecdotally interesting. I mean, where I live in Florida, of course, and everybody's moving here, but we haven't seen prices drop at all. What we've seen is nothing happening.
Well, that's why it's not
right?
dropping.
I mean,
there's no comps being set.
Right. Yeah, because if you have a 3% mortgage, you're not selling your house to go buy one with a 7% mortgage, and if you're a buyer, you're just kind of waiting, right? I see Dave Weisberger in the audience, and I think we talked about that literally on Monday on our Macro Monday show that we do together. So, like, we haven't really seen this major real estate collapse. We haven't seen a collapse necessarily in the job market. And I'll be honest, man, you see things like Goldman Sachs pricing in 100% chance of a recession, and everybody's so sure. When has everybody ever been right?
Don't get me started on that, man.
I'm not saying there's a recession coming, but I'm just saying if you have any sort of counter indication, it's when everybody is sure that one thing's going to happen.
Just like everyone is still sure that stocks are going to go down immediately, and that's why all these anonymous bear accounts keep getting retweets and engagements. It's like it's not how this works. Okay, so Scott, going back to you. Okay, so you got the bond side. You're kind of waiting on the cryptocurrency, not doing too much on the trading side. What else are you doing during the day? It sounds like your investment side is kind of set for now. So how are you keeping yourself busy?
All the things I mentioned at the beginning. Really creating content, research, endless seemingly meetings, meeting new people, hosting things, guesting on things. Honestly, as insane as it sounds, basically just talking about, writing about, and thinking about this space can take up quite a bit of time. And so that's really where the focus is. A lot of research, a lot of deep dives, a lot of try to figure out what the hell is going on, right? Because I think if you choose to speak openly about what's happening in the space, you have a responsibility to be as well informed as possible, which is extremely difficult when the news cycle is so fast and furious and generally opinion and not fact. But that's what it is. So, as much as I might not be deploying daily, I'm preparing myself to do so when the moment is right, and I think that takes a lot of research on a daily basis.
By the way, I will say for those in the audience, unless you're day trading, that's the way investing should be. It's not like you should be constantly looking at what's going on second by second. There's more productive things you can do with your time. Listen, in my case, I mean, I'm focused on building, like you, a brand, an audience, on the media side, because what else am I going to do during the day? Yeah, right. That's kind of taken care of, right? So it's just being out there as much as possible, trying to provide some guidance and suggestions and ideas. But for the most part, what else are you going to do other than sometimes just wait for the fat pitch to come your way?
I just spend my time listening to Dave. I always joke the old meme. If you're the smartest person in the room, you're in the wrong room. Well, I can tell you that I'm always in the right room because I'm never the smartest person there, and I like to keep it that way, and that's how I keep myself informed. Between all those things I do, like I also have to record. I generally record 5, 6, 7 podcasts long form a week. So, it's 4 to 7 a.m. every day. I'm writing my newsletter, then I'm with my kids. But then it's, an hour and a half of prep for a YouTube stream, hour YouTube stream, 20-minute break, record a podcast. And by then it's already noon or 1 o'clock. And I haven't even looked really at the market, since the morning. So it's very busy.
Yeah, no, it's a grind. I don't know if people realize how how difficult it is to get a following, especially on like YouTube. And you've done a great job on that, but it's a lot of work. I mean, I think people take it for granted when they just see some nicely polished video and content, not realizing how many hours it can go into even just the editing of it.
It really is a lot. Luckily, I have a small but extremely hardworking and talented team that helps with all those things. Obviously, helps with research and prep and gathering everything. But I mean, I spend a lot of time in front of the camera, producing this stuff.
For those that want to be in your circle of influence, let's call it, how do they find you? How do they sign up to your stuff?
The easiest place to find me is on Twitter, unless, of course, I'm mysteriously shadow banned like everybody else in crypto, apparently. Scott Melker, SCOTTMELKER on Twitter, and everything else links from there. I have the Wolf Den newsletter, which comes out 5 days a week, completely free. And then obviously my YouTube channel, also under the name Scott Melker. And, you can find the podcast quite literally, on any platform. And actually, interesting, I haven't even talked about this, but next Monday, I'm launching a second newsletter, which is completely AI and data driven. No human interaction at all, alongside the tie. I don't know if you're familiar with the tie, but they're kind of like a Bloomberg for crypto. So, they have a terminal dashboard, and it's institutional only. It's never really been available for retail. I'm lucky enough that they let me use it, but I'm also I'm also smart enough, I should say, or dumb enough, you can say, that I only understand about 5 to 10% of what's available there. And so I think I'm a pretty good reflection of retail. And so we've basically just gotten together to launch this thing. It's called the Daily Close. It'll come out at 7 p.m. basically every day, starting Monday into perpetuity, and includes basically a screener of everything that happened in the market, top trending news, all, like I said, AI and data driven. I won't even touch it on a daily basis. And then all of their sort of like custom lead indicators and summary of the data of the day, outlying coins, how the top 25 performed, trending NFT projects, basically everything. So I've been working my ass off on that, and that'll launch next week.
Everyone check that out. Thank everybody for joining. Thank you, Scott. I'm going to take some Pepto-Bismol. Just how bad my stomach's.
Dude, Godspeed, my friend. Nothing worse in the world than food poisoning. Oh, God.
Feel bad.
Yeah, no, and everyone check out my app, How You Dish, which is for connecting foodies to each other. So with that said, thank you, Scott.
Thank you so much.
Cheers.